The stock market is going to new all-time highs while the interest rates are at levels we haven't seen since 2001. Guys, it is so crazy what's happening in the markets, and in this video I'm going to explain to you exactly where I think we are in the stock markets and why I'm actually pretty worried on what is going to come in the next coming years. And I'm going to show some examples to power the vision that I have right here. So guys, let's jump straight into it. First of all, guys, this is like one of the craziest things we've ever seen probably in our lifetime, is the amount of increase that happened with the interest rates. This red line right here, that is the federal fund or the US interest rates. And what we can see right here, that this has such a crazy increase in a short amount of time. This is so crazy that we actually haven't really seen that in the past. So the previous time we had like a cycle of interest rates. So we have like, normally when interest rates are increasing, money is becoming more expensive. So eventually that will create a selling pressure on the regular financial markets. And when the interest rates are very low, normally that creates buying pressure on the regular financial markets. So for example, right here, you can see the interest rates has been low for a long period of time. That basically means that money is pretty cheap. It's quite cheap to borrow money. So a lot of that borrowed money is also ending up in the stock market. It's ending up in the housing market. It's ending up basically everywhere because money is so cheap. Right? The moment interest rates are going up, money becomes more expensive. So people will think twice to invest in stocks, or a lot of people are not able to buy that home. So this is actually, with high interest rates, the economy definitely looks way different, right? But we need these cycles of up and down. At least that's the system that we are in right now, because if it's always low, you get a period of, you will go into hyperinflation. If it's always high, the whole economy will collapse. So the Federal Reserve is basically balancing between issuing money into society in a cheap way with low interest rates, or taking money out of society with the high interest rates. And this mechanism is also controlling the markets. So for example, right here, we can see that here the interest rates have been increasing. It goes steady for some time, right here, 2.4%. And we still had like a kind of blow off top phase. We still had this massive rally, but eventually you could see that we had a big crash occurred as well. This was the March 2020 crash. Because of that crash, the interest rates went very quickly, very low. They went very low, almost back to zero. And then you can see that rallied, that spiked another rally in the S&P 500. Well, the time before that, we had also rising interest rates. That was after the correction we had at the dot-com bubble. So the year 2000, we had a big correction. Also a very big decline of interest rates right here. Then when the markets started to turn around again, interest rates were coming up, also quite rapidly. Not as rapid as we are seeing right now, but also quite rapidly. They stayed stable a little bit roughly around 5. And the moment they start to cut interest rates, so they start to cut it, put it lower again, that is the moment that the market just completely started to crash. And we had a correction of the top right here till the bottom, of roughly 50%. And guys, this correction was pretty crazy, because even though there were people that were not in the stock market, they even lost money. And how can you say, how is that possible? If people are not in this market, how can they lose money? Well, they had their money inside a bank. That bank was using their money as collateral for these markets. So when these markets crashed and collapsed, the money from those people also disappeared. So there were some banks that basically went bankrupt and lost people's money while they are not even positioned in the markets. And that is pretty crazy if you think about it, because in most countries you're kind of obligated to use a banking system, right? Without a banking system you cannot participate in the economy, so you're actually being forced using a bank system. It's not every country, but most countries. Then the bank is using that collateral that you bring to the bank for things like this, for example, trading the stock markets. And when it goes wrong, the end user, who actually has nothing to do with the stock markets, he just uses the bank as a service for payments, can get the problems and lose their money. So it is a completely unfair system where the end user is actually taking a risk for a reward that is never there. There is no reward for the person putting the money in the bank. So that's also, I'm going to go to that part later into this video. I just want to share some more signals with you, but that's basically how it works. And what we can see right here is just generally when the interest rates are going up this rapid and they stay up right here, it will create sooner or later a big selling pressure on these regular financial markets. And I think this won't be different. It's just the other side of the story is just that it's very hard to time that. It's very difficult to time. You might not even want to time it. A lot of people say the moment that interest rates are being cut, the moment they are going down again, they are being cut, that is the moment you want to scale out. Because often when it cuts right here, you see that last push up and then it goes down. Here for example, when it cuts, we already went down, so we didn't have really that last push. But you can imagine the news already, right? Well, interest rates are down, money is cheap again, and we have a small push before everything collapses. This is maybe the most important reasons I have for that. There's definitely something going on with the regular financial markets sooner or later, and that this will take its toll. It will have an effect sooner or later. That's what I believe. But if we zoom in on the regular financial markets and we have this rising channel right here, we are breaking out to the upside of this rising channel. This is also insanely bullish in the immediate short term. So you also got to be realistic. The breakout of this channel to the upside without being a failed attempt of breakout, so if it doesn't roll over again, but if it just goes up, it's very bullish and might even bring us in a blow off top phase. A blow off top phase is where this is a good example of a blow off top. Maybe you can maybe I can show it to you with a parallel channel right here as well. Something like this, where you also have like a rising channel, and then suddenly we leave that channel, we get that final push, which maybe takes a couple of months, and after that push we can see a further correction. I think something similar right here is possible, where we are really approaching the end of a major top, but that major top can be a very explosive move. It can be a very explosive move. We have seen it with Bitcoin too in 2017. That was a classic blow-off top where it just went from 10 to 20,000 and then just had an 80% correction. Next up, guys. Next up. That is the cycles that I'm tracking. And this chart is basically different than this chart, because this is the S&P 500 as it is right now, just the regular chart. But this chart is the S&P 500 divided by the money supply. So this chart is actually taking inflation into consideration. What we can see right here is that we actually broke a heavy resistance. That is very interesting. Right now we are also at somewhat of a resistance, but we never surpassed the highs of the year 2000. So right here, the year 2000, and this was the dot-com bubble crash. This was the 2008 housing market crash. So here you can already see that the high, the double top pattern in the normal chart right here, this was the top of the dot-com bubble, the top of the housing market right before that crash. It's not visible here. Why is that? Because, well, the moment this crashed, there has been created a lot of new money. And that new money is being calculated into this chart. So if you look at the purchasing power you had right here, with the same amount of money you had right here, your purchasing power is lower. So that's why this chart is basically lower than this chart, because the amount of money right here would be the same. This was at $1,500, this was at $1,500, but the purchasing power right here was way lower than right here. So therefore this chart is actually a little bit, or kind of straightforward, a complete illusion. Because here you think we actually have a double top pattern, maybe even have a new all-time high, while in fact we never came close to these levels in terms of purchasing power. And purchasing power is basically what you can do with your money, right? If you have $100 in an economy that only has a $1,000, then you own 10% of the supply and you have very much money. But if you have $100 in an economy of 10 million, or 100 million, or 10 billion, it's becoming already less. So $100 means nothing if you don't know the circulating supply. That's also the power of Bitcoin, right? So the money always has a value in comparison to the rest of the money. So if you only know the amount of money, there is no meaning to that. The meaning comes from the circulating supply. That's why I think this chart is also more interesting and better, because it also shows us we have now, right now we are trading at highs we haven't seen since 2001, so we are getting closer to that top of the dot-com bubble again, which is pretty interesting, I have to say. But nevertheless, this chart looks very different than this chart. Also, this chart could be signaling a blow-off top phase. Why is that? Well, we have that rising channel. We are right now at resistance. We could do something like this, where we just break out to the upside and get that blow-off top. Maybe come as high as the levels we have seen at the dot-com bubble. And maybe from there we can roll over, right? Maybe it's not going to happen. Maybe it's going to be like this. But one thing that I think is very interesting is that the bottom of the business cycle that I'm actually tracking is coming in 2026. 2026 is also corresponding with a 4-year cycle low with Bitcoin. And the previous time we have seen bottoms of business cycle, there was right here in 2008. Top of the business cycle was in the year 2000. Here we had another bottom of the business cycle. Here we had another top of the business cycle. So this is already very interesting that the price right now trades higher than the basically the top of the business cycle that we are in right now. Makes me also wonder actually what's going on. Right? Are we really into this healthy market conditions where we just, I don't know, do something like this and just go up, and that this might be the bottom of the business cycle and that we then just continue to go higher? It's possible, but with the things that I'm presenting to you in today's video, I don't think it's the most likely. Like I said, these interest rates is the first thing that for me comes to mind. This is a pretty heavy situation, which I think eventually will take its toll. Next up, let's go to the next one. The next one is the basically the Dow Jones Transportation Average Index. And this is interesting because what we normally see is that the transportation index from the Dow Jones is basically a precursor to what's going on with the regular financial markets. So when there is a divergence between the two, it's often the Dow Jones Transportation Index is leading the regular financial markets. So let's have a look at some examples. Right here we have the Dow Jones Transportation Index going lower, while the regular financial markets still went up. That was a small divergence. This is a weekly chart, of course. The Dow Transportation went lower, and we actually had a correction in the regular financial markets as well. Was not the biggest correction, gotta be honest. Here also we got some highs, lower highs, lower highs, lower highs. Higher highs, higher highs, higher highs in the regular financial markets. Also a clear divergence with the transportation index, which is also representing a big chunk of the economy. That divergence eventually resulted in a drop. And here we can also see right now already this Dow Jones Transportation Index, they makes lower highs, while the regular financial markets makes higher highs. And that's definitely also one of the signals that could be an early sign of that the regular financial market sooner or later is going to turn around right here. And is going to see that correction with the selling pressure that will come from the amount of interest rates. Next up, guys, the next thing that I want to talk about is the money supply, United States money supply. What we can see right here is that the money supply hasn't been really going up. Right, the money supply has been contracting. It's been slowing going down. The last time it went up was right here, 2019. We all know that because there was a lot of quantitative easing going on. The markets also went pretty high up. But we haven't seen that new liquidity being injected in the economy yet. So this is also, again, also reflecting a little bit high interest rates, because with high interest rates, this will also stay lower because there will be less people borrowing money and so forth. But still, this shows that there is less new inflow to sustain the current levels of the regular financial markets. Then we go to the next part of the video, and this is a little bit my game plan. Just want to have a very quick talk about that. Let me know in the comment section, by the way, what you think about this video. I don't want to be too much the doomsday prepper, but I also want to be realistic. And I've made already a plan in the year 2022 when Bitcoin was in the bear market on how I'm going to behave, or what I really expect from the markets in the years to come. And so far, we actually have been, it is already unfolding where we have been talking about. That is the Bitcoin 16-year cycle. I had my doubts, of course, in the last months, or in a couple of months in the year 2023. Why? Because there still could be a regular 4-year cycle. So there were some people saying, but yeah, you were expecting a correction. Yes, in some periods of time, there was still a likelihood of a bigger correction in Bitcoin due to the fact that it was still not a very clear whether we see a 16-year cycle or regular 4-year cycle. Right now, in my opinion, it definitely looks more like we are in that 16-year cycle. Right now, I can say with more certainty that it looks like that. So then we come to the next part. This is ownership, guys. And the thing is, we all want to be active in the financial markets, but who actually owns what we think we own? Who owns what we buy? So when we have our money in our bank, do we own that money? Whether we have stocks, do we own that stocks? Whether we have Bitcoin, blah, blah, blah. Well, the short answer is to most of these questions, no, you don't own what you buy. So if you earn money and you save that money in a bank account, you don't really own it. The banks owns it. You just have an IOU. You got a paper, you got a contract basically with the bank that they owe you a certain amount of money, which you are holding there. But they own it. But they own it, but they owe you. But when the market conditions come in such a extreme way, like with a crash, recession, whatever, in certain circumstances, they don't have to fulfill their obligation to owe you. So you store your money at the bank, they lose it because the regular financial markets will completely crash. You're also able to lose your money. It really depends on also the government policy, if they are going to do bailouts or if they are going to do bail-ins. Well, it is said that bailouts are not going to happen anymore. Bailouts are basically new money that's being printed, being sent to the banks to cover for all their losses. Then you get a shitload of inflation, of course. The story goes that that's less likely. Bail-ins means basically that the banks say, hey, I'm sorry, but the money is gone, so we don't have it anymore. So eventually, always the end customer, you and me, are always the victim in this case. Because when the bailouts come and new money is being created, the money that you already owned is worth maybe 50%. So you actually pay for the loss anyway. Then when they do bail-ins and you lose the money so you cannot spend it, you also lost it. So there is no real ownership in there. Then we have stocks. Stocks is the same thing. It's also an IOU. You don't possess the stocks at your house. You don't have, basically, when the market crashes or the bank loses in this game, you don't have nothing to stand on. You don't really own stocks. I think, even though, and this is very interesting from David Rogers Webb about the Great Taking. There's a documentary about this on YouTube. He even says that the bank doesn't own them. So the stock exchanges who basically has the administration of who owns which stocks also don't own the physical stocks. There's another institution that owns the physical stocks. And then if the markets were to collapse and a lot of money will be lost, the physical stocks will still be owned by that institution, but the IOUs from the stock exchange or from the bank to you, those one will be gone. So at the end, you lose your possessions while they still exist. That is the crazy part. Bitcoin, another thing. Bitcoin does, of course, right now has an ETF. Well, if you buy Bitcoin with an ETF, you also don't really own it. That's also an IOU. If you store your own keys, which I definitely expect everyone who's watching this channel is doing, yes, then you own it. You own your Bitcoin when you store your own keys. If you do self-custody, your own Bitcoin. So that is coming to the next part, the last part basically. And that is, hey Jeroen, what is the solution? Well, first of all, I got to be very clear, guys. I'm not a financial advisor. And I also got to be very honest with you. I really don't know. Because I haven't seen anything like this before in the past. And I'm not even sure if I'm right. I'm just very cautiously right now just telling to you what I'm seeing, and what I'm just basically seeing in a quick summary. I think we are on the later phase of a rally right here, coming with a blow off top, which will be followed with a huge correction, maybe even starting and a recession starting in 2024, going on until 2025, 2026. But I'm also well aware that I can be completely wrong about this, and for me personally, it doesn't really matter if I'm right or wrong. This is something that I see, so I want to take action on it, even though I'm not completely capitalizing, right? I don't have to completely go doomsday prepper, but at least I want to act on it partly. So if there is a chance that this is going to play out, I am somewhat protected by it. So how can you protect? Well, first of all, important thing that I personally think, and again, I don't know whether that's the best for you. Maybe you can also listen to David Rogers Webb about the Great Taking, is to don't have any debt. That's the first step, to don't have any debt. There are also a lot of people who are starting to rent their house instead of buying it with a mortgage. Because, for example, if you have a debt but you lose your money, you start at zero, but you still got that debt. So in the year of 1929, when the Great Depression happened, there were a lot of wealthy families which suddenly, out of the blue, became poor. But they might even became more poor than the already poor people, because the poor people didn't have any debt, and the rich people, they became poor and still had that debt. So the first thing, what I would think, if such a situation would occur, such a doomsday situation or like a similar situation as 1929, the Great Depression, I would say no debt. No debt is one of the most important things. So once you are out of debt, you can think about where to store your wealth then. Well, I would personally really look for multiple currencies. Maybe you want to even store some cash, but like multiple currencies, maybe multiple bank accounts with different banks. But you also maybe would like to think about some physical things, like physical gold, physical silver. If you own any Bitcoin, which 100% you do, of course, you should self-custody, not your keys, not your crypto. But I guess that's something I don't need to tell to you guys. But that's something that I would do. So the first step is to get debt-free, and then diversify your investments into physical gold, physical silver, self-custody of Bitcoin, and the currency that you're holding. maybe do it into different banks, maybe have some different banks open, even in different countries. So guys, the more you divide your money, the more you split your risk. And one thing that I want to tell you guys also, what's very important, sometimes sit down and think about, what am I when all my money is gone, when my job is gone, when my house is gone? What's left of me, and do I like that? And what can I do to improve that? How can I work on that? Because there are a lot of people, when there's nothing left, they will make the best out of it and they will still feel great. And that is also power. That is also an asset. You can call it mindset. I don't think it's completely mindset. It's maybe a way of life. It's something that you can cultivate as well, probably. So I think that's also a very important question, right? In the end, money is just money. And yeah, it's also a very big asset in life when suddenly everything's gone, but you still can smile and you still can make the best out of things, right? Guys, that was it for today's video. I want to quickly mention that in the past couple of weeks, I actually published some videos, 3 videos, which I think are very important. Last video didn't got that much views. That was how to identify bull and bear markets. I think it's actually kind of crazy because there are a lot of people that create like trading courses. They ask thousands of euros, thousands of dollars for these courses. But for me personally, the knowledge that I have in crypto, I'm just dropping it here for free. For me, this is very valuable information. If I knew these types of information before, like years ago, that was actually that would really be a game changer. And might not be for everyone because it's not maybe always too difficult to too easy to understand. I also understand that this is not for the beginner traders because it is quite heavy material. But once you understand this, it might just expand your perspective or understanding of the markets completely. Like how to identify bull and bear markets using sentiment and using like derivatives exchange data is crazy. You can define market conditions with this stuff. You can very early already recognize a bear market if you're flexible enough to see it. But if you got the right data and if you know where to look, definitely can help a lot. This is a very valuable video, and I'm pretty shocked that it's only got 300 views. This one, Bitcoin trading course will change everything you thought you know, is also a very important video because this video, I'm basically putting 6 years of my experience into a 1.5 hour video. I know it's long, but nevertheless, if you want to become a better trader, I would definitely urge every single one to watch this video from the beginning till the end. Maybe watch it even a couple of times. This is true gold. Okay, guys, that was it for today's video. Let me know in the comment section what you think about this, the great taking. Maybe you have seen the documentary from David Rogers Webb. Let me know in the comment section. Let me know how you would prepare, or if you think it's completely nonsense, that's also fine. Just give me some nice reasoning and I will look into that as well. I want to thank you all for watching. I want to wish every single one of you a beautiful day, and I hope to see every single one of you in the next video.